In this video, we're going to discuss some of the advantages of using Lifo. So the biggest advantage of Lifo is that you're going to have lower taxes. In periods of rising prices, it's going to decrease your profitability. And the reason is that rising prices are going to lead to a higher cost of goods sold. And higher cost of goods sold is going to lead to lower taxable income, which I'll just abbreviate TI. So let me walk you through an example. It'll make it a little easier for you to understand. So let's say that you have the following inventory purchases on 3 dates, right? So this is throughout the year. January 1, you purchase 100 units at $8 a unit. And then on June 30th, you purchase 250 units for $9.50 a unit. And on December 31st, you buy 100 units and you sell, and the cost per unit is $10. Now, you go and you make a sale of 100 units, let's say at the end of the day on December 31st, and you say, okay, how do I go about valuing what the cost of goods sold would be? Well, if you're using Lifo, you're going to take the last 100 units purchased, right? And again, what you sold, let me just make this clear. You sold 100 units, and so now you're determining your cost of goods sold. So at Lifo, let's put it right here. Lifo, your cost of goods sold, your COGS, is going to be 100 times $10, right? So that's just going to be $1,000. That's your cost of goods sold under Lifo. Now let's instead assume that you used, and let me change colors here. Let's instead assume that you used Fifo. Your cost of goods sold under Fifo is going to be first in, first out. So what were the first goods purchased? It was the 100 units purchased on January 1st. So you take the 100 times the $8 cost for those 100 units, and that would be $800 cost of goods sold. So by using Lifo, you have a higher cost of goods sold. Why? Because the price went up. The price that you paid for the unit went up over the course of the year. And so now you're taking this more recent price, the last units you purchased, and you're using that to value your cost of goods sold. So your cost of goods sold is $1,000 instead of $800. So it's $200 higher cost of goods sold. So it's 200. I just took the 1,000 minus the 800. So 200 higher cost of goods sold, right? Right here that we just talked about, having a higher cost of goods sold with Lifo. Now what does that mean? Well, cost of goods sold is higher, then your taxable income is going to be lower. So if your taxable income is going to be lower, that means you're going to have an increased cash flow because you're going to pay less in taxes. So now, of course, you might be saying, well, hey, I've got this higher cost of goods sold. My book income is actually going to be lower because I'm taking a higher cost of goods sold. But that's really a cosmetic effect, right? That might affect your earnings on your income statement and so forth. But in terms of actual cash flow, you want to maximize the cash flow for your firm, right? So you reduce taxable income, you increase the cash flow. And we'll talk about the financial statement effects and the book income effect in that when we talk about the disadvantages of Lifo, but that's more a cosmetic effect. So you also get better matching of costs with Lifo. It's not just this tax benefit. And the reason is that you're using the more recent, more relevant costs that you're matching against your revenues. And why I say it's more relevant is because if you say, look, I sold the good for this price, and someone says, okay, well, what was the cost? What did you pay for this thing that you sold? Maybe you sold it for $11 a unit. Well, the most recent cost is going to be the most relevant because this price paid on January 1st, for example, that's an old, stale price, right? So with Fifo, you're getting these, if we were using Fifo, we became this stale price that we'd be matching against whatever we sold the unit for. But what investors and people care about most is the most relevant, the most recent price, right? That you don't care what it was, the price was a year ago or a couple of years ago. You care, if you're an investor or somebody, you care what's the price right now. So you want to match the more relevant or more recent costs against your sales, at least in terms of just from a matching perspective and just giving better information to investors. But another benefit, and this is probably a little more subtle than the first two benefits, but you're going to have fewer inventory write-downs when you're using Lifo, assuming that prices are increasing, which they typically are. So the reason that you're going to have fewer write-downs is this. Think about it. So if you're constantly moving out, when you have a sale, you move out the last or most recent inventory, right? So here we sold 100 units. So what units went off the books? Well, this 100 units right here. So what is valued in our inventory? Well, these units here, right? So those are going to be, if we were to look at our balance sheet at the end of that year, these would be the units that would be showing up in our balance sheet. So we're going to have an understated or a lower inventory level, because it's just the flip side of, right, we're having higher cost of goods sold if we use Lifo. Well, that means we're going to have lower inventory because our inventory is at these lower values here instead of using this higher price here. Now, why does that mean we'd have fewer write-downs? Well, think about it. A write-down occurs when the price of our good or our inventory declines, right? So if we say, you know what, hey, we thought that this was worth, let's say $12 is like the market value that we were planning on selling this for, but then it drops and the market value goes to let's say $10. Or wait, you know what? Let's use $9.75. That'll be a better example. So let's say the market price of this inventory dropped to $9.75. Now, if we're using Lifo, when we look at what our inventory is valued at these values, right? Okay, so we've got 100 units on the books at $8 a unit, 250 units at $9.50 a unit. And $9.75, the value is still higher than those values. So we don't have to write down our inventory if we're using Lifo, because even though there was a price decline from $12 to $9.75, we don't have an issue. However, if we were using Fifo, so let's say we were using Fifo, and we instead, so Fifo, we would have got rid of these units here, right? So we would still have, these units would still be in our inventory at $10 a pop, right? And let's say, so you've got 100 units at $10 a unit. Forget about these units here for the moment, but let's just say you had 100 units at $10 a unit, and then the value goes down to $9.75. Now you say, hey, wait a minute. The market value of what we could sell this inventory for is now less, right? It's less than what we paid for it. So now we might have to take an inventory write-down, right? So basically think about it like this with this fewer write-downs. With Lifo, you're getting rid of the more expensive inventory first, right? You're getting rid of the higher cost inventory as soon as you get it. You're moving that out. And the ones that are going to build up in terms of the inventory are at the older stale prices that are lower. So it's just going to be it's not that you couldn't ever have a write-down, right? I mean, if it went down to $7 a value, then all of these would require a write-down. But it's just something to think about, is that you're getting the higher priced goods. You're moving out of inventory more quickly with Lifo, and so you're going to have fewer inventory write-downs.